right? In the worst possible case, the government can simply buy back their own bonds that they are issued without recourse to anything else, right? So that's the kind of liquidity that the banks had, right? Now, what about the maturity of the deposits? This had very little to do with the government itself. Now, if you have to have a bank run, remember that what happened in the UK, starting with Northern Rock, was largely because the government was scared of further bank runs, right? And they went into HBOS and the others precisely because of that, right? So first of all, government banks, mostly bank runs are very, very unlikely. Second, they are fairly liquid, even if there were to be a bank run. Third, where would the bank run come from? Look at the structure of most of it is time deposits. You can look at this. These are the figures. So if you look at the numbers going, so on that scale, over 80% of the deposits are time deposits, right? And this is across bank groups. This is not as if this is specific to a particular bank group. These numbers are not driven by a particular bank group. The only ones which don't have that are the regional rural banks, which is for good reason. These are sort of small banks in rural areas to provide small credit to small artisans and so on. And if you look at the structure over here, most of it has maturity 1 year or more. Very, very difficult to withdraw that money. Right? Bank runs are not going to happen very easily. Right? Now, if you put it all together, what happens? What has happened over here? What has happened is the strong presence of the state in the banking sector has, one, reduced uncertainty or the risk for the investors, risk for counterparties for every transaction. Second, the banks have not essentially expanded into areas or expanded credit to the extent that would make their balance sheets vulnerable, right? In part, it's because the incentive structure also doesn't exist. If you work for a government bank, by selling $1 million worth of mortgages, you are not going to get any bonus, for example. You have a salary and you got to stick to it, right? So given the absence of the incentives, the balance sheets didn't expand very much, right? The banks didn't get into structured products. And remember, this is the state ownership of banks is very critical for this. If you have to develop any kind of fixed income market, and structured products at the end of the day are fixed income securities, if you have to develop any kind of fixed income product market in India, the state banks have to pay ball. If the state-owned banks do not become active buyers and sellers in that market, you're not going to have that market because you'll simply not have enough counterparties to complete any transaction. This is precisely why the government bond market in India is fairly well developed, but the corporate bond market isn't. Because the government, the state-owned banks, or all banks rather, are required to hold not so much in corporate securities, right? So that has one impact, which is that certain kinds of financial engineering that we have seen in this part of the world was not there very much, right? The bank's balance sheets certainly didn't have much of those. Right? So to begin with, there was less of a risk with the balance sheets, and to the extent there was, the government presence didn't basically made investors much more much more ready to invest in those banks or deal with those banks as counterparties in the money market and so on. And of course, what happened is that if you go back to my first slide, you will see that come the Lehman crisis over here, the monetary policy also eased up quite a bit. But what is key is that whereas monetary policy eased up in the UK and the US, nevertheless transactions were not taking place because of the risk. Here, transactions were taking place. Right? So basically the crisis, the market didn't freeze up for an extended period of time as it did over here and in the US. Okay? Now, does the government presence in the sector has its problems? Yes, certainly. I mean, lack of good service at public sector banks or lack of innovativeness in certain cases is a problem, right? However, in this case, it has turned out to be a boom. The other thing which people overlook quite a bit because it's not directly viewed together with the banking sector is capital account convertibility. If the banks were allowed, for example, to pick up overseas assets without any restrictions, we don't know what would have happened. There's no counterfactual to that, right? I mean, if they had, for example, bought into a large amount of the mortgage-backed securities that originated in the US, which is what happened in a large number of European banks, for example, things could have gone bad, right? However, the capital account restrictions means that they cannot do that. That's another part of the story. That's where regulations come into place. So two key pieces of regulation: capital account restrictions, liquidity of the banks, and one legacy issue, which is the state presence in the banking sector, state ownership of a large piece of the banking assets, right? Those are the factors that prevented this from happening. When did the Indian policymakers start sort of veering in the direction of going slow on these kinds of reforms? Essentially from the Southeast Asian crisis. At that time, I was in India, I was working for credit rating agency, and the debates that I had with people and the debates that were going on around the country essentially suggested that the independent economists wanted the progression towards financial liberalization to be much more rapid. When the Southeast Asian crisis came about and India escaped pretty much unscathed, right? And remember, that was a period when India had to take three different hits. First, the Southeast Asian crisis. Second, the Russian default. And third, India tested its nuclear weapon. So there were sanctions on India at that point in time as well, right? It pretty much escaped unscathed from all those three. And the Reserve Bank of India and the others came to the conclusion that in large measure, it was because of capital account reforms or the lack of it, right? That we were less integrated with the rest of the world, and therefore we were not suffering as much, right? And that's what sort of slowed down to a large extent, as far as I can understand, the pace of reforms, which in hindsight seems to have served India well. Yeah. Thank you.